Alright class, let's take a closer look at the facts of the case. We have Patriot Corporation acquiring all the shares of Sandstone. The first step in any business combination problem is to figure out exactly what the acquirer, in this case Patriot, is giving up to make the deal happen. This is called the consideration transferred. The problem tells us that Patriot is issuing 20,000 shares of its common stock. Now, it mentions a $1 par value, but for acquisition accounting, what we really care about is the fair value of the shares on the date of the acquisition. Here, that's $75 per share. That's the number we'll be using for our calculation. There's also a second piece to this deal. Patriot agreed to a potential future payment if Sandstone hits certain revenue goals. This is called contingent consideration. The problem gives us the probability-adjusted present value of this obligation, which is $30,000. This is also considered part of the purchase price. So, that's what Patriot paid. Now, let's look at what they received. And this brings us to the single most important principle in this topic. We account for an acquisition based on fair value. We are only interested in this fair values column. Sandstone's old book values, including their retained earnings and common stock accounts, are completely irrelevant to Patriot. We are buying the assets and assuming the liabilities at their current market worth. Notice how some assets, like the computer software and the in-process research and development, had a book value of 0, but they have very significant fair values. Under the acquisition method, we get to record these previously unrecognized assets on the books at their full fair value. This is a critical concept. We'll use these numbers in a few minutes to calculate goodwill or potential bargain purchase gain. Okay, now that we've deconstructed the facts, let's move on and formally answer the first question in the problem. What is the fair value of the consideration transferred? This is the total purchase price Patriot paid for Sandstone. First, we calculate the value of the stock that Patriot issued. That's 20,000 shares multiplied by the $75 fair value per share, which gives us a total of $1,500,000. But we're not done. We also need to include the fair value of that potential future payment. So, we add the $30,000 for the contingent consideration. Adding those together gives us our final answer for Part A. The total consideration transferred is $1,530,000. Okay, next, let's address the transaction costs, which are covered in Parts B and C. This is an area where students often make mistakes, so let's make this very clear. The problem mentions two distinct costs, the $10,000 in stock issuance costs and the $75,000 fee paid to the investment bank. Under acquisition accounting, you must treat these two types of costs completely differently. They go down two separate paths. The $10,000 in stock issuance costs are viewed as a direct reduction of the capital raised from issuing that stock. Therefore, that amount reduces additional paid-in capital. It never touches the income statement. On the other hand, the $75,000 investment banker fee is considered an acquisition-related expense. It's a cost of making the deal happen, and the accounting rule is clear. It must be expensed in the period you incur it. This does reduce your net income. The most important takeaway here is that neither of these costs is ever added to the consideration transferred or capitalized as part of goodwill. They are never capitalized. That's a critical rule to remember for the exam. Now that we've clarified how to handle the costs, let's move on to see how this all gets recorded in the main journal entry. Okay, let's move on to Part D, which asks how the issuance of these shares specifically affects the stockholders' equity accounts of Patriot, the parent company. We need to break down the value of the stock into its two main components. First, we have the common stock account. The rule here is very strict and simple. The common stock account is always increased by the par value of the shares issued, nothing more. So, as you see, we take the 20,000 shares issued and multiply them by the $1 par value. That gives us a credit or an increase to the common stock account of $20,000. Easy enough. Next, we have additional paid-in capital. This account is credited with the excess of the stock's fair value over its par value. The total fair value of the stock we issued was $1.5 million. Since we already accounted for $20,000 of that in the common stock account, the remainder $1,480,000 is initially credited to additional paid-in capital. Okay, let's now address the main event, calculating the amount of goodwill that Patriot will record from this acquisition. We're going to walk through a reconciliation schedule, which is a very clear and logical way to present this calculation. We always begin with the total purchase price. As we calculated earlier, the fair value of the consideration transferred is $1,530,000. Think of this as the starting point. It's the total amount that Patriot paid to acquire Sandstone. Now, from that total price, we need to subtract the value of all the individual assets and liabilities that we can identify and measure. We list them out at their fair values. The receivables at $116,500, the patented technology at $138,000, the valuable computer software at $876,000, and the in-process research and development at $470,000. Of course, we also have to account for the liabilities Patriot assumed. Notice that the liability of $484,000 is shown as a negative, as it reduces the overall value of the net assets we acquired. When we sum all of those individual components up, the total fair value of Sandstone's identifiable net assets comes to $1,116,500. This represents the fair value of what Patriot got. Alright, here is the final, crucial step. The difference between what Patriot paid and the value of what they got is the premium. This premium is paid for all those valuable things we can't put a separate number on, things like brand reputation, a talented workforce, or expected synergies. In accounting, we call this premium goodwill. So, subtracting the value of the net assets from the consideration transferred leaves us with goodwill of $413,500. This is the amount that Patriot would record as a new intangible asset on its balance sheet as a result of this acquisition. Now, let's explore part F of the problem. This is a classic what-if scenario designed to test our understanding of what happens when the facts change. What if Patriot stock had only been worth $50 per share on the acquisition date instead of $75? How would that have affected the consolidation? Okay, let's look at our schedule again. If the stock price changes, the very first thing that's impacted is the total consideration transferred. The $1,530,000 we started with is no longer the correct number. Our new consideration is 20,000 shares times the new $50 price plus the 30,000 for the contingent consideration. This gives us a new, lower purchase price of $1,030,000. So, Patriot paid less. But notice, the fair value of the net assets they received is still $1,116,500. So what happens now? When we subtract the value of the assets from the price we paid, we get a negative number, and you cannot have negative goodwill. The goodwill label just doesn't make sense anymore, because this isn't goodwill at all. When the consideration transferred is less than the fair value of the net assets you receive, you have what's called a bargain purchase. Essentially, Patriot got an incredible deal. And that difference of $86,500 is not recorded as a negative asset. It is recognized immediately on the income statement as a gain on bargain purchase. This is great news for Patriot's bottom line in the current year. So, instead of creating a new intangible asset, This bargain purchase actually increases Patriot's net income, a very different outcome indeed.